Hi guys, welcome back to In Case of Econ Struggles, and welcome to another AP Micro Struggle. Today we're talking about topic 2.8, which is the effect of government intervention in markets. Here's what the College Board says you need to know about this topic. We're going to talk about price floors and price ceilings and whether or not a price floor or ceiling is binding or not and what that means for the market. Then we're going to talk about taxes and subsidies, and throughout both numbers 1 and 2, we're going to talk exactly about what deadweight loss is, where to find deadweight loss, and what deadweight loss represents. So timestamps are below if you would like to jump around, but let's get right into it. Let's start off with our talk about price floors and price ceilings. I've done 4 little cells here. We're going to focus mainly on the binding column in here, and then the row is just a price floor or a price ceiling. So let's start talking about a price floor. So a price floor, if it's binding, is a legally minimum price that is above the equilibrium price that would occur if we didn't do anything to this market. So throughout, let's just think about donuts again because I think it's easy. So if we're thinking about donuts, this is the equilibrium price of donuts that would prevail if we didn't touch this market at all. But maybe the local city government passes a law that says you can't pay any less than $2 a donut. $2 a donut is definitely above the equilibrium price of a donut. So what's going to happen is Deb and all her donut shop friends are going to say, well, if everyone's going to pay us $2 a donut, that's awesome. We're going to crank out a lot of donuts. And all the people, all the consumers who buy donuts in this town are going to say $2 a donut is a lot. I'm only going to go down and buy a donut if I really, really want a donut. So you can see what's going to happen is the quantity demanded of donuts is going to be a lot less than the quantity supplied of donuts. And what's going to happen is we're going to have a surplus. So Deb and all her donut shop friends are cranking out donuts, but no one is willing to buy those donuts. Now, what would happen if we did not have this price floor is all the people who own donut shops would say we're charging too high of a price, and they would start lowering their price until we got back to this green equilibrium, but they can't do that. So we're stuck permanently in this surplus situation where we have more quantity supplied than quantity demanded. If we think about the opposite case, where the city government passes a law about donut prices, but now they say you can't charge more than 50 cents a donut, well, that's going to be what we call a price ceiling, and it's binding if this price ceiling, shown in this purple dotted line here, is below the equilibrium price that would occur if we didn't do anything to this market, if we didn't pass a law about donut prices at all. Now what's going to happen is Deb and her donut shop friends say, well, if I'm only allowed to charge 50 cents a donut max, I really don't want to make that many donuts because that's not really that high of a price for me. And you're going to have a lot of people in this town who say 50 cents a donut sounds great. I'm going to get a donut every morning before I go to work. So every morning there's a line out the door for donuts. But Deb and her donut shop friends are not willing to make that many donuts, so we have a shortage because quantity demanded is much higher than quantity supplied. And again, we have this price ceiling, so the donut shop owners are not allowed to raise their price back to equilibrium and get us back into this equilibrium spot right here. Now, notice in both of these graphs, after we put in this price floor or price ceiling, we have this interesting triangle here with a question mark. We're going to get into that in 1 second. After I just briefly talk about the fact that notice on this right-hand side in this right column of not binding, here the minimum price is below the equilibrium price, so this really isn't binding. This doesn't affect the market at all because maybe the minimum price is like 50 cents, but in equilibrium the price is $1. $1 is above the minimum, so they're fine. Similarly, if the maximum price for a donut was like $4, but the equilibrium price was $1, that price ceiling has no bearing on this market because we're just going to stop at $1. We're not going to go any higher. So that ceiling doesn't affect us. Turning back to this idea of this little triangle right in here that we saw in the price ceiling example is what we call deadweight loss. Okay, the meaning of deadweight loss is the value of trades that are lost due to the government intervention in the market. It's a really technical definition. Let's think about more of what that means in English. So notice that before we were trading, we were buying and selling donuts at this green line here. This was the quantity supplied and demanded when we didn't touch the market at all. But now with this price ceiling, we're only buying and selling this many donuts here with this black dotted line. So notice that we're not buying and selling as many donuts as before. And what's happened is before, all of these people on this demand curve were willing to pay a price that was above a seller's willingness to make and sell that donut. So if we hadn't touched the market, these people would say we're willing to pay this much for a donut. These people would say, hey, we're willing to sell a donut for this much. They would have agreed to trade. And so the surplus, like we saw in that previous video on consumer, producer, and total surplus, they would have had a positive total surplus here at each of these points. And so what we're going to do is we're just adding up all of those surpluses in this little triangle. We say, well, these surpluses no longer occur. because those trades no longer occur, because we're only buying and selling this many donuts instead of this many donuts. So this is sort of like the value of economic activity we lost when we put in this price ceiling, and that's exactly what deadweight loss is capturing and what it means. So you can also think about deadweight loss as the difference in total surplus before we put in this price ceiling or before the government intervention and after the government intervention. And when we have a binding government intervention, we're always going to have some sort of deadweight loss. Now, taxes are going to have the same effect on the market whether or not you tax the buyer or tax the seller. So I've shown both graphs here. I'm really only going to talk about the case where you tax the buyers. If you would like a separate video on taxing the sellers, comment below. But let's get into this graph right here. So if we're taxing the buyers, the first thing we're going to do is if it says, for example, we're going to tax donuts by 20 cents, and this tax is on the buyers, I'm going to shift the demand curve left by 20 cents. The reason I'm shifting it to the left by 20 cents is because now it's equivalent to saying the price is going up by like 20 cents. Now, when I shift the demand curve, I'm only looking for QT or quantity tax, and that happens when the new demand curve intersects the old supply curve. So right here on this line is the quantity after tax, or QT. How do I find the price the buyers pay and the price the sellers receive? Well, the price the sellers receive is right here at the supply curve in QT. The price the buyers pay is on the demand curve at QT. What exactly does the price the buyers pay and the price the sellers receive mean? Well, if we implemented a 20-cent tax, that means for every donut that's sold, the government needs to get 20 cents. So if we raise the price on buyers, the donut shops are going to say, well, we probably shouldn't actually raise our price by 20 cents. What we're going to do is we're going to raise our price by 10 cents. So now the price the buyers pay is $1.10. And what we're going to do is we're going to take that $1.10, we're going to subtract 20 cents, put that in an envelope and send that to the government. The remaining 90 cents we will put in our cash register. So the price the sellers receive per donut is 90 cents. The price the buyers pay is $1.10, and 20 cents is going to the government, which is the size of the tax. So if we take the size of the tax of 20 cents, we multiply it by the quantity of donuts bought and sold with the tax, we're going to get government revenue. That's how much tax revenue the government gets. And once again, similar to what we just saw, this triangle here, which is the value of lost trades due to the tax, is what we call deadweight loss. So just to summarize, you move the supply curve to the left. Wherever the new demand curve hits the old supply curve, that's the price or the amount the seller receives. You simply follow that quantity up to the demand curve, and you're going to get the price the buyer pays. And the difference between the price the buyer pays and the price the seller receives is the size of the tax. If you multiply the size of the tax by the quantity bought and sold with the tax, you're going to get government revenue. This is going to work the same exact way. You'll get the same exact numbers if you shifted the supply curve instead of the demand curve. On the other hand, you could also do a subsidy. A subsidy is when the government is trying to encourage more goods to be bought and sold in the market. Once again, you can do the same thing by subsidizing the seller or the buyer. I'm going to talk about the case where you're paying the seller, but if you would like a separate video on subsidizing the buyer, comment below and I will get that working. So what's going to happen here, I'm going to shift the supply curve to the right by the size of the subsidy. So maybe now instead of a tax of 20 cents per donut, the government is paying a subsidy of 20 cents per donut. So I'm going to shift the supply curve to the right by 20 cents. Where the new supply curve hits the old demand curve, that's going to be the price the buyer pays. If I follow that quantity, that Q subsidy, all the way up to the old supply curve, that's going to be the price the seller receives. The difference between the price the seller receives and the price the buyer pays is going to be the size of the subsidy. If I multiply that size of the subsidy by the quantity of the subsidy, I'm going to get the cost of the government, or the negative government revenue, the money the government has to pay to make this subsidy work. Just to make sure we're clear, once again, if the original price of a donut was $1 and it's a 20-cent subsidy, the donut shops are saying, well, we get 20 cents more per donut. We're not just going to keep charging $1. What we'll do is we'll start charging 90 cents, so the buyer only pays 90 cents. We're going to get 90 cents from the buyer, but we're also going to get 20 cents from the government. So we're going to get $1.10 overall for each donut. And again, if we were to do this shifting demand instead of supply, we're going to get the same exact numbers, the same exact conclusions from this. And that sort of is how a subsidy works, basically. When we talk about taxes, there are two terms that are frequently asked about, and they're sort of confusing, so I just want to talk about the difference. So if we have a $2 tax and the buyer is paying 50 cents and the seller is paying $1.50, we would say that the burden on the buyer, the actual amount of the tax paid by the buyer, is 50 cents. and the burden on the seller's tax burden is $1.50. If we wanted to think about that in percentage terms, then we're talking about tax incidence. So the buyer's incidence or tax incidence is 50 cents over $2, so they're paying 25% of the tax, which means the seller's incident or the percent of the tax that the seller is paying is the remainder 75%. And this burden and incidence is heavily related to elasticity, which we've talked about in a previous video. Specifically, whichever side of the market is less elastic or more inelastic is going to pay a higher burden or a higher incidence of the tax. So for example, here supply is really elastic and demand is really inelastic. If I were to place a tax on the buyer or a seller, it doesn't matter, but I'll move the demand curve to the left. Notice that my QT doesn't change that much. And notice here that basically the buyer is paying 100% of the tax because they're the more inelastic side or the less elastic side. Similarly, if I have really inelastic supply and relatively elastic demand, you can see that when I shift that demand curve to the left, this is a leftward shift of the demand curve by about a similar amount in the first example. Notice that here the buyer is paying pretty much the same as they used to, but now the seller is taking a lot less money in. The price the seller receives is a lot less than before. They're basically taking the hit of most of the tax. So this is how tax burden and tax incidence is related to elasticity. If you're less elastic, you pay more burden or more incidence. To summarize what we've seen overall, government interventions in a market, if those are binding interventions, they will cause some sort of deadweight loss or lead to negative revenue for the government if we're talking about subsidies. We know that taxes and subsidies are going to have the same result whether or not you shift the demand curve or the supply curve. And we know that the less elastic side and the more inelastic side of the market is going to pay a higher burden or higher tax incidence. So if this was helpful, make sure to like and subscribe, and we will see you next time for another case of econ struggles.